Have you ever wondered how companies decide on their financing strategies? What drives their decision to use internal funds, borrow, or issue new shares? These intriguing questions find answers in the pecking order theory, a concept related to a company's capital structure. First proposed by Stuart Myers and Nicholas Medloff in 1984, the pecking order theory suggests that managers follow a hierarchy when considering sources of financing. They prefer using the company's retained earnings first, then debt, and finally they resort to equity financing if necessary. But why this particular order? The answer lies in the concept of asymmetric information. This term refers to a situation where one party holds more or better information than another, leading to an imbalance in transaction power. In the corporate world, managers often possess more information about the company's performance, prospects, and risks than external stakeholders like creditors and investors. Consequently, these external users demand a higher return to counterbalance the risk they're taking due to this information asymmetry. Now, the pecking order theory starts to make sense. When a company uses its retained earnings for financing, it minimizes this information asymmetry. There are no external parties involved, and thus, no need for extra compensation due to the risk of information imbalance. This makes internal financing the most convenient and cost-effective source of funding. But what happens when a company needs more funds than its retained earnings can provide? That's when debt and equity come into play. Managers generally prefer debt over equity for a couple of reasons. Firstly, the cost of debt is usually lower than the cost of equity. Secondly, issuing debt often signals confidence in the company's prospects, suggesting that the board believes the investment will be profitable. In contrast, issuing new shares sends a negative signal, indicating that the stock may be overvalued and that the company is seeking to generate funds by diluting ownership. Consider also the seniority of claims to assets. In a bankruptcy situation, debt holders have a higher claim to assets than stockholders, so they require a lower return. This makes debt a cheaper source of financing than equity. So to recap, the pecking order theory suggests that companies follow a specific hierarchy when choosing financing sources. They start with internal funds or retained earnings, then move to debt, and finally resort to equity if necessary. This order arises from the concept of asymmetric information, where the company's managers hold more information than external stakeholders, leading to a preference for financing sources that minimize this informational imbalance. It's a fascinating insight into corporate financing strategies, shedding light on the complex decisions companies make every day.